It's called the 4% rule, and it doesn't work any longer. Your Money Matters is next on Talk 107.3 FM.
And welcome back to Your Money Matters, your weekly peek inside the complex financial world. You listen to the show so you can retire with peace of mind. And what better people to tell you about that than Christy Smith, president of the Presley Group, and Matt Kennedy. Christy and Matt are experts at helping you plan for a successful retirement. They teach their clients how to position their retirement money to avoid losses due to stock market conditions. They have helped hundreds of clients achieve their retirement goals, and they can help you. Here are your hosts for Your Money Matters, Matt Kennedy and Christy Smith.
Good morning and welcome to Your Money Matters. I'm Christy Smith, founder and president of the Presley Group. And oh my gosh, it's so exciting to be here this morning. It's a new year, and I do have to take a minute to say thanks to Matt for the last several weeks. We've been in and out. Rick and I have been in and out doing things with the family.
A lot of traveling, yep.
This is the first week back, and I am just so excited to be here. I'm joined this morning with my co-host, Matt Kennedy, and, we have got so many exciting things going on at the Presley Group right now.
Yeah, it's a busy time and a busy year. And as we go throughout the show today, a couple of things we're going to talk about. Retirement income is always very important, and Robert Powell from Market Watch has written a great article about what's wrong with the 4% retirement rule. We're going to touch on that. The danger of the sequence of returns in the stock market, why you have to watch out for not how volatile the market is, but for when the market is volatile. We'll touch on that. And also earlier this week, Christy, Governor Jindal threw out a very interesting idea on Thursday. The governor said, what if we scrap the state income tax and we scrapped the state corporate tax and went with a state sales tax that was higher? We're going to hear from an economist from the Tax Foundation at the end of the show today on whether or not that's a good idea. So we've got an action-packed show today, a lot to talk about on this edition of Your Money Matters.
Well, we really have an action-packed 2013, to be quite honest with you. So many good things are coming up. We're excited to announce that we're moving into a new office, and so within the next 2 or 3 weeks, we will be moving into a brand new office. Well, brand new to us, and it's on Veterans Boulevard in Denham, and we're so excited about that.
So my office will now be bigger than the broom closet?
Absolutely.
Thank you,
You're actually
Ricky.
going to be able to meet clients in your office, Matt.
It's so nice.
We are so excited about it. And then not only that, we have the opportunity to be featured in Forbes magazine. So for those of you who listen to us week in, week out, grab Forbes magazine in February. We are featured in there. It's a article on tips for health, wealth, and success for 2013. And so we're real excited to be in Forbes magazine.
What an honor. What an honor.
Well, it really is, because, yesterday, Matt, I was talking to a gentleman. Ironically, I'm buying things for the new office. I had to go buy a new light at one of the stores here locally. And one of the gentlemen that was helping me, he said, Christy, I hear y'all on the radio every week. And he said, I haven't even begun to make a plan. He said, I really need to start working on retirement planning. And he said, but the problem is you just don't really know who to trust, And I said, why don't you just come in and we can start small and build as we earn your trust? Because, the reality is in this day and time, we can't expect you to just give your trust,
It has to be earned. Oh, absolutely.
And so he scheduled an appointment next week to come in and meet with us for the first time. And it was really such an honor for me that he chose to come in for that first visit, because, I do understand right now it is hard to know who can you trust.
I think there's two great fears. There's the fear of whom can I trust? Whom can I rely on? There's also the fear of, I don't know if I want to know how far behind I am in retirement. I've actually had clients on a first visit say, Matt, the hardest thing for me to do was to agree to meet. Not because I don't trust you and Christy and I don't want your advice, but I just don't feel like I've saved enough. And sometimes, Christy, there's this great fear of saying, am I going to be okay? But once you answer that question, once you have the courage to say, let me find out where I am now, we can help you create the plan that gets you where you need to be, even if you're retiring in only a short time.
And then another problem that many of you have is that, once you do decide to take that step and get advice, what you find is that you hear conflicting opinions.
Ugh.
I have a gentleman that's been coming into the office the last month or so, and, we're going to talk about the 4% rule soon, but, when you go to one place and they rely on a plan that requires a projected growth of 7-8% in the market, then only to see that, the 4% rule doesn't apply any longer. It's not working. It's not effective. They have to decide not only who do we trust, but they have to decide what type of plan do we want to use. Do we want to use a plan that's based on assumptions, or do we want to use a plan that's based on guarantees?
Yeah.
And that's what we can do at the Presley Group is we help you structure a retirement plan that is built on guarantees. It's real exciting when I can put my head on the pillow at night and know that we really made a difference. I mean, we really did. And so many times I hear this. I mean, weekly people come in and they come in for annual reviews. They come in as new clients. And I hear often, I wish I would have met you 10 years ago. That's a real common statement at the Presley Group. I wish I would have met you 10 years ago. But, I always say God brings you to us when he's ready for us to have you.
Absolutely.
And he's ready for you to have us. But, not only that, Matt, we do have some other things coming up for 2013. We've got my book. My book's going to be out in our hands in March, and we're going to actually have that book on hand for our open house in March. It's called Plan, Protect, and Preserve. And, I'm real excited. We've been working on this book. Well, Matt,
Christy,
when I hired you 5 years ago, we were working on it.
Can I tell on you?
Yes.
You won't be embarrassed, will you?
No.
So I met Christy about 5.5 years ago when she first started doing a radio show, got to know her, went to work for her, all of that, okay? But it was when I first went to work with you, 4 and 3/4 years ago, you mentioned something about having a book, and I said, well, you need to finish it. You said, well, I don't want to finish the book until I lose some weight for my cover photo.
Well, guess what? I haven't done that.
But you are putting the book out.
Well, you want me to tell you why?
Tell me.
I have a great photographer.
Thank you.
Aaron Hogan, I Wonder Photo. Aaron has the... that eye to him. He can do magic things with the computer.
I like it.
And he just makes me look better.
So what's the book about?
The book is about estate planning. We are certified estate planners. Now, we're not attorneys, but we are certified estate planners. And really, one of the things that we focus on when you come in to meet with us is not only helping you build a strong financial house, but we want to make sure that you have a strong estate plan so that if something happens to you, everything goes the way you want it to go.
Because if you save, but then you blow it on the estate planning part, what ends up happening is all that hard work may be taken away by the government. But, Christy, I know the first thing so many people think, well, I don't need estate planning. I'm not a multimillionaire. Estate planning is for everyday Joe and Janes.
It absolutely is. It absolutely is. I mean, even those of you who are in your early 20s, beginning families, need a good estate plan, and that's really what this book is talking about. It's addressing the issues that we have here in Louisiana because we are a unique state. I said state.
You're hungry?
Yeah.
We are a unique state because we have Napoleonic Code.
We do, and it makes us different. And so we have to address those issues differently than we would in other states. And so, I wrote this book really to give good generic information to guide people into making good decisions. We're not trying to replace attorneys. What we're trying to do is we're trying to give you a good reference guide so that you can determine whether or not you need a living trust, do you need a will. There's just different things that you can do to protect yourself. And this book is really designed to be a guide. And we're going to have this book on hand when we have our open house in March at our new office.
And I want to stress, too, that, so oftentimes you were talking about whom can you trust and, when you meet with somebody, do you know if you're getting good advice? One red flag is if you're constantly being sold, and arm twisted. I can tell you at the Presley Group, it's about getting to know you and your family, your extended family. What are your hopes? What are your fears? What are your dreams? And more importantly, what are your goals? Then we craft a plan that meets those goals, not a plan that sells you something, but a plan that says these are the goals. How do we meet them? And that's what I love about working with you, Christy, is that it's not about twist their arm, get them to do something today. It's about creating a lifetime plan.
Our office number is 791-5773. 791-5773. Our office is in Denham Springs, right off the interstate. If you're not in Baton Rouge, our phone number is 800-791-5773. 800-791-5773. And you can always go to our website, safemoneyplan.net. safemoneyplan.net.
It's a great website, lots of resources there, and more about what we do and how we can help you. Coming up in just a moment, it's called the 4% rule. Supposedly, it's the rule that says if you only draw out 4% a year from your retirement accounts, you'll be fine. Your money will last. Well, that rule may not work anymore. We'll talk about that and the danger of the sequence of returns as Your Money Matters continues here on Talk 107.3 FM. And good morning. Welcome back to Your Money Matters. It's presented by the Presley Group. I'm Matt Kennedy, licensed agent with the Presley Group and working with Christy and the Presley Group now about 4.5 years. Boy, time flies, Christy.
Yeah, it does.
4.5 years. And Christy is the owner, founder, and president of the Presley Group. Bottom line is we've been helping people make their retirement dreams come true for
Matt,
over 15 years.
You're talking about over 4 years. And the funny thing is I had a gentleman that came into the office about a month ago, and he's in sales and about to retire in sales. And he asked me, he listens to you on the radio. So, of course, he knew you were still on the radio and yet working with us. And he asked me, he said, how's Matt doing? And I said, oh, he's doing great. He said, well, is he good? And I said, what do you mean good? And he said, is he a good seller? And I'm like, well, do you want the honest truth? He said, yeah. I said, no, he's not a good seller at all. I said, but he is good at teaching people what we do. And he's real honest. And so he's a great person to work with, because you're not going to find someone that's going to be more, more accurate and really explain to you, the plan. And See, he was like, okay, well, I'll work with him then,
I take that as a compliment.
It was a compliment.
I don't want to be the greasy-haired salesperson.
No, that's why I'm telling you this. It absolutely was a compliment.
Well, we're teachers, and that's why I came to work with you, Christy. Well, that and the direction of the good Lord above. But we're teachers, and we can show you how to protect and preserve your retirement nest egg. If you think we're over the fiscal cliff, think again. I don't say this to scare you. Here's an article right here at MarketWatch.com. The most read article is by Paul Farrell. Washington clowns to set up a 42% stock market drop.
Wow.
Now, here's the gist of his article. And he may be right, he may be wrong. But the gist of his article, Christy, is that while we avoided the true diving off the fiscal cliff, lawmakers have set up a series of cliffs. What are we going to do about entitlement reform? What are we going to do over the next 2 to 3 months about Social Security and Medicare reform? What are we going to do about the debt ceiling? And Paul writes that every one of those cliffs is going to be met with a big stock market reaction. We're looking for a very volatile year on Wall Street. And if your goal is to protect and preserve your retirement nest egg, to not worry about losing your money if the market does go down 42%, that's how we can help. 791-5773 to learn how to protect your portfolio from market downturns. Also at MarketWatch.com, our good friend Robert Powell has a great article, Retirement Income, What's Wrong with the 4% Rule? Now, Christy, let's start by explaining, and you can help me with this, the 4% rule. What is it?
Well, when we talk about the 4% rule, we really talk about the fact that, over the past 20, 30 years, when you go to a brokerage firm and you retire and you say, hey, here's my 401k, I want to roll it over, and I want to make sure that I never outlive that. Okay. So typically what we will hear is that we can withdraw on average about 4% a year and expect not to run out of money. Okay. But what we're seeing, and we have seen in the past, is that this 4% rule is really not working.
Robert Powell's article, and I'm going to post a link to this, by the way, on our website at safemoneyplan.net. But what Powell writes is that the 4% rule to be safe is really now more of a 2% rule. And it's based on the fact that the market has become so darn volatile. He writes, quote, the problem with the approach of the 4% rule is that it's based on a single point in time. In other words, Christy, at some point you have to tell that brokerage firm, okay, here's my nest egg. Now let's turn it into a stream of income at 4% withdrawal a year and hope and pray we don't run out of money. The single point in time is a problem.
Well, and the fact is, Matt, that most of the time when people are doing this, they're actually in the process of retiring.
Yes.
You know,
right.
that's a critical point.
Now, let's talk about that point in time. I don't want to get all geeky with fancy terminology, but here's a phrase, sequence of returns. That sounds fancy, but all it means is year after year, what does the market do for your portfolio? What does the market do to your portfolio? And this sequence of return problem is what's making the 4% rule invalid in today's retirement environment. So, Christy, let's just tell a story. Telling a story will make it a lot easier for you all to understand. We got two brothers out there. We'll call them John and Joe. By the way, if your name is John or Joe, apologies.
We're not talking about you.
So you got John and Joe, and they're two brothers, and they're approaching retirement. Now, it turns out they both had $800,000 in funds at retirement. They retired. Let's make them retire from Exxon, all right? They've got $800,000, and that money, their lump sum, has to last them the rest of their lives. Now, John is 3 years older than his brother Joe. A couple of numbers here, so follow along. John's 3 years older. John retired in 2000. Joe retired in 2003. So they both went and sat down with their friendly broker person, and they were very concerned that they would have enough money to last. And the 4% rule says, oh, you'll be fine. The 4% rule says if you take out 4% per year, you have better than a 90% chance of not running out of money up until age 90. Now, there were some planners they sat down and talked to, Christy. There were some planners who said they could even withdraw 8% in some years, and that would be okay if they kept all of their money exposed in the stock market. I clear my throat because we just met this past week with a gentleman who went to one such large firm, and the rate of assumption of growth was how much, Christy?
7.6% a year.
That's incredibly aggressive.
Yes, especially when you know his situation and understand that he probably told the broker the same exact thing that he told us, was that he needed a guaranteed income. He needed, he's on the verge of making a retirement, move. I mean, this man has worked for a national corporation for, a long time.
Many years.
And he's ready to retire. But he needs to know that he is going to have a guaranteed income that's going to last as long as he or his wife are alive.
And that's the real key.
It is.
And his wife. Okay.
Yes.
So guess what? Let's go back to Joe and John. Joe and John, even though they were told, you could fudge and maybe take out 8%, live the high life, you'd be all right. But they decided to stick with the 4%. They were conservative, and so they did. So let's go back to John. Remember, John is older. John retired in 2000. Joe retired in 2003. So let's stick with John. John retires on January 1st. And guess what? He pulls out $32,000. Easy math, right? 4% of $800,000. At the end of 2000, he had $759,552 in his account. Why? Because the market went down in 2000. So he pulls out $32,000 again. And he keeps doing this. Christy, for 2003, he pulls out $33,000. Now he's down to $56,051. The market went down in 2000, 2001, and 2002. And all those bad things happened, the dot-com, the terrorist attacks. In 4 years, his account was down 29%. Now, Christy, his income had not changed. Do you think our friend John is nervous?
Absolutely. He's probably not sleeping at night.
He's probably freaking out.
Yeah, that's why we that's why we give a sleep mask in our welcome kit.
Yeah.
Because when clients become our clients and they get a plan that has guarantees, they don't have to worry. They're able to sleep at night.
Because we're not basing your returns on what we think the stock market will or won't do. We're basing it on guarantees. Now let's go to Joe. Just to recap, John's older. John retired in 2000. John had $800,000. John took out $32,000 a year. Okay? And by the way, when we talk about market performance, I'm just looking at how the true S&P performed. Joe ended up down 29% and probably panicking. Now let's talk about his brother Joe. Joe is 3 years younger. He retired January 1st, 2003. Christy, I'll let you give the numbers this time. So he pulls out his $32,000, and at the end of the first year, lo and behold, look what happened to Joe's money.
Well, at the end of the year, he had $987,000.
Because the market went up so much in 2003.
Yes. But, again, for the next year, he pulls out an additional $32,000.
And look at his balance.
At the end of year 2, he has over $1 million.
$1 million, roughly $60,000. Now, he's not taking any more money out than his brother, but his timing was so critical when he started. So now he pulls out his $32,000. Oh, you know what? He decided, I'm doing good. I'm going to take out an extra $1,000. I'll take out $33,000 to account for inflation. At the end of year 3, he's got $1,076,000. After year 4, his account's at $1.2 million. His brother's like, what? Well, hold on. His brother is at $567,000. He's over $1 million. What's the difference?
Well, the difference is time and market conditions.
And the difference, most critically, is when you start. The first few years of your retirement withdrawals are so critical. If you time it wrong, folks, and you start taking withdrawals when the market is highly volatile and goes way down, you will cripple your retirement if you don't have at least some guarantees on your plan.
Well, and if you get lucky, you're going to be like John. You're going to end up with more money. But the problem is, who really wants to rely on luck with their retirement money? And,
don't make it a crapshoot, right?
I got to stop here, Matt, and I got to talk about, the man that we're both working with right now that came into the office. Now, this gentleman came in about 2 years ago, and he was just discussing the, what was available, the options he had available, but he wasn't really ready to retire. So now he's really serious about retiring, and he comes back to meet with us, and we're blessed that he chose to come back and see us. But what I found so interesting is that, his company led him to a major brokerage firm, not one local, and, that firm ran him some illustrations so that he could do a comparison, okay?
Sure.
Now, when he came into the office to meet with us, the first thing he said is that he needed guaranteed income. He does not want to take a chance on running out of money, okay? And he knows what dollar amount he needs on an annual basis to live comfortably. So, he really knows what he needs, but we were able to create him a plan that would ensure his goals are met. We were able to create him a plan using an insurance company with a guaranteed income rider that would immediately guarantee him a retirement income for the rest of his life.
No matter, and this is key, no matter what happens in the market.
Right.
And that was what got the brother John in trouble here, right?
Yeah, absolutely.
Was that the market hurt him so poorly, if he keeps taking out 4% a year, he's going to run out of money, Christy.
Well, he absolutely is. And that's exactly what could happen to this gentleman that we're working with. Because, on the second or third visit, he comes in and he says, here's the proposal that I've gotten from, I'm not going to use the company's name. I'm going to say XYZ, a brokerage firm. And he said, I want you to look at it and tell me what your thoughts are.
And the first thoughts you and I had were, wow, that is unbelievably aggressive.
Well, it's a real bold assumption. I mean, in this day and time, to assume that you can live on the amount of money he needs to live on, he would have to make a 7, almost 8% average return. And is that realistic? I mean, some years we will, some years we won't. But I found it rather bold that in their assumptions, they were actually using over a 7% return. I mean, this is where we see things like this, Matt. You know, we look at these two brothers, John and Joe, and we say, okay, you know, they both did the same thing. It was a matter of timing. It was a matter of time, things that are not in our control. And we understand that we are not in control of the stock market ever.
Ever. And can I just briefly run out all the way to 2009?
Yeah.
John, the brother who was hurting because he had gotten in the market when it started going down, if we go all the way out to 2009 and Joe keeps taking out $32,000 and then steps it up in 2007 to $34,000 to fight inflation, Christy, at the end of 2009, his account values $367,000.
Wow.
His brother Joe, who started in 2003, in 2009, he's got $753,000. He's got almost the same amount of money he started with. The brothers were taking out the same withdrawal. Folks, it's the timing. It's the timing. And if you're close to retiring and you're thinking, well, I've been told that I can take out XYZ percentage and I should be okay. Don't make it a should. Make it a certainty. Make it a guarantee.
Well, and not only is it the timing, but it's the nature of the investment. We have plans. They're hybrid plans. They're available now. They can help you have a guaranteed retirement future. You know, I call it a successful retirement. I know people come in the office and they kind of laugh when I say it's a successful retirement. But to me, a successful retirement means you don't have to worry. And we can create one of those plans for you if you just give us a call and schedule your no obligation consultation to come in and meet with us. Our phone number is 791-5773, 791-5773. Or you can go to our website, safemoneyplan.net. Safemoneyplan.net. You can actually request an appointment on our website. We'll be back in a couple of minutes with more of Your Money Matters.
There are plenty of people who believe a safe retirement is too good to be true, that there is no safe place for you to go with your money. Even your very own government will try to tax it right out from under your nose. But you've just tuned in to information that can save your retirement nest egg. It's Your Money Matters, featuring two of America's top retirement specialists, Christy Smith and Matt Kennedy with the Presley Group. They can teach you how to retire without all of the risks. Now, let's get back to Your Money Matters.
Welcome back to Your Money Matters. You know, at the Presley Group, we specialize in helping you have a successful retirement. In fact, we even give sleep masks in our welcome kit because we know that once we've been able to work out a plan for you, you're going to be able to sleep at night knowing you're never going to run out of retirement money.
I actually had a couple of clients make phone calls to the office in late December. Hey, Matt, yeah, it's XYZ. I'll not name names. This fiscal cliff is approaching. I'm all good with my money, huh? Yep. Because you have a contractual guarantee that says if the market tanks, you don't lose. And the first thing people always say to us when they meet with us is, okay, that sounds really good. It sounds too good to be true. It's not too good to be true. You just have to understand how it works.
Well, and the way that we're able to offer these products, you know, we call them hybrid products because, you know, we typically see people go either into the market and accept the risk to reap a higher reward.
In other words, they could be John or Joe. Mm-hmm. It could go either way.
Or we see them, flee to safety, you know, in the bank because we want to, you know, they want to make sure they don't lose their money.
Well, and CDs are paying such great rates these days.
Well, but the problem with CDs is that you can't keep up with inflation. And so, you know, what we see is that, you know, people are really looking for alternatives. And we have a hybrid between the two. It's called a fixed indexed annuity. And what this hybrid account does is it allows us to use insurance companies. And might I add, we use very strong, sound insurance companies.
A-rated.
To put your money into a plan that is going to allow us the opportunity to link your returns to different indexes on the market. Now, one of the common indexes that we use is the S&P 500. Now, because your money is not in the market, if you if the stock market rises 20% in a year, we are not actually going to see a 20% gain because your money's not in the market. What we've done is we've tied those returns to the performance of that index. So, if we see a 20% gain in the market to the S&P 500, we might see a 10% gain to our account.
Typically.
So we're willing to give up some of the earnings potential so that when we see market conditions, go down, we don't accept any losses in our account.
And that is the bottom line. At the end of the day, do you want to say, I want everything the market gives me up and down, which is risky in retirement because you're no longer working. You can't replenish those funds. Or do you want a plan that says, I am willing to accept some of the gains and not have to worry about any of the stock market losses? That's how our plans work.
Well, when people come in the office, I always ask them when, their money's in the market, I say, so you're telling me that because your money is invested in the stock market, you're telling me that you're willing to accept all of the risk. You're willing to accept that you could lose everything. You don't know. When your money's in the stock market, there is no stop loss that says, hey, when it gets to this, we're good. There's just not. And so with a fixed indexed annuity, we're able to give you the peace of mind to know that you are not going to lose money ever again due to stock market conditions. Now, there is one other factor that we didn't talk about, Matt, and that is time. These plans are really not plans that we're going to use for money that you say, Christy, this is my money that I'm saving for a new roof on the house. This is not money that we're going to, we're not going to put money that you're saving for your car into a fixed indexed annuity. These plans are really designed for long-term money. Maybe that money is retirement money. Maybe that's money that you've saved that you're planning on leaving to your children that you really aren't going to spend. There's lots of different reasons why people don't spend their money. I find IRA money, 401k money is really a great pool of money that we can use in a fixed index annuity. And many of you are over 59 and a half still working at your job and don't even realize that, but you have the opportunity in most cases to take a portion of your 401k out as an in-service distribution, keep it tax deferred, but yet take control of that money and position it into an account that has these guarantees. Because let's face it, what if you were the one that was working and retired and invested your money just like Joe? Joe retired in 2000, January of 2000, and had to start living on his nest egg, immediately. What if that was you? It doesn't really feel good when you have that uncertainty, when you get those statements and you see the value of your account getting lower and lower and lower. And I'll tell you, in down conditions, I actually see people come into the office and bring their statements. They're sealed up in the envelopes, Matt. They do not even open them and look at them because they're too scared to see what they look at.
We saw that in 2009. People would come in and say, I know I need help, and here's my, Edward Jones statement. I'm not picking on Edward Jones, but here's my statement from my brokerage firm. And it was sealed. You haven't looked? No, because I'm scared to look. It's almost like going to the doctor. You know something's wrong. You just don't want to hear the doctor tell you what it might be. But unless you address the concern, you're going to always get the same result. A volatile market, a volatile return on your money. As you get close to retirement, or if you are retired, we can show you how to eliminate all of that volatility, participate in market gains, without putting your money at risk.
And when you look at people like Robert Powell who say, the 4% rule may not apply anymore, you have to understand that we have to start doing things differently than we have in the past. We just do. And a fixed index annuity strategy may be the perfect solution to you, but you won't know it unless you call and schedule an appointment to come in and meet with us one-on-one and let us talk about your needs, your goals, your dreams so that we can help you accomplish them.
Our number is 791-5773. It's no obligation, no fees, no pressure. We sit, we talk. That's what we do. Actually, a guy the other day paid us the highest compliment. It was our first appointment. We actually sat at the McDonald's and chit-chatted a bit. And when we were done, he said, you know what the difference between you guys and those other guys would be? I said, no, what's that? He said, you're the only person who's ever let me talk. Everybody else has always tried to tell me what I should do. You said, what do I want?
Well, and that is a great compliment. And unfortunately, we don't see that very often in our industry.
Well, we're trying to help. We're trying to figure out how can we help you, not just today, but down the road. If you're going to retire, this is a lifelong decision.
It absolutely is.
So it's always a free, no obligation, one-on-one visit. It's always free, and you can schedule that by calling us at 791-5773, or you can schedule your appointment online. It's very easy. Go to safemoneyplan.net. That's our website for the Presley Group. Simply enter safemoneyplan.net, and you'll see on the right-hand side of the homepage there, schedule a consultation, pre-appointment consultation. Click on that, answer a few questions, and we'll be in touch with you early next week to set up your free, no-obligation, one-on-one consultation. We've been talking a good bit about the 4% rule. When we come back, one of the big questions is, do retirees, or those of you who are near retirement, do you stay in the market or get out and take a break as the market's roaring higher and higher? Robert Powell from MarketWatch.com has written a great article. Is it time to stay in the market, or is it time for retirees and near retirees to look at getting out, or at least getting a portion of your money out of the market? We'll talk with Robert Powell when we come back in just a moment here on Your Money Matters, presented by the Presley Group. Again, our phone number is 791-5773. Our website, safemoneyplan.net. Well, I guess it's the $64,000 question, or if you're really wealthy, the $640,000 or $6.4 million question. Bob Powell, MarketWatch.com, asked the question, retirees and stocks, sell now or hold on? And Robert Powell joins us. Robert, for a lot of people with the market at all-time highs, it's got to be a tough decision, right?
Well, it is a very tough decision, and I think you'll get as many answers as there are experts out there on the subject. So in a column I wrote, I actually portrayed some of the extremes and some of the more moderate points of view. So there's one point of view that says stocks are at an all-time high, and that means that they're extremely risky right now. And so if you're a retiree or a pre-retiree trying to build a nest egg or preserve a nest egg, what you don't want to do is have all your money tied up in things that are volatile. And so if you are in a place where you've been able to maybe get back to even, or you have to ensure that the money that's there will support a lifestyle that you want, some people are suggesting that you trim back on stocks now, because you don't want to. What you don't want to do is have a risky asset, an asset that moves up and down in value,
right,
used to generate income that must be there to support some standard of living.
And as I mentioned at the outset of the show, that really is our specialty at the Presley Group, helping you create guaranteed retirement income. Now, if you're not in need of retirement income, you're just concerned about market risk, well, our plans are obviously designed to protect you from market downturns, let you share in gains when the market is rising. But one of our real specialties is being able to sit with you and determine how much income you need, and then take the appropriate portion of your retirement nest egg and turn it into that guaranteed income. So if that's what you're looking for, as Robert's talking about, don't hesitate to call us. Schedule that free one-on-one consultation at 791-5773. Area code 225-791-5773. We're chatting this morning with Robert Powell from MarketWatch.com. Robert, one of your colleagues, Brett Ahrens, recently wrote a column at MarketWatch.com where he referenced an article that was in the Wall Street Journal about how mom and pop tend to be the worst investors. And what he talked about in the article was that oftentimes, our decisions are so driven by emotion. When the stock market plummets, mom and pop say, I'm getting out. And then when the market begins to rise, at some point, mom and pop say, I'm going to hop back in. So often, though, as Brett points out and the Wall Street Journal article points out, mom and pop hop back into the market at exactly the wrong time. We get out when it's low, but we get back in when the bull run has already happened. Then we suffer another loss. And Brett talks about how this has really ruined a lot of people's retirement dreams by trying to market time, and that market timing is messed up by emotion. Do you find that, too, as you cover retirement and write about retirement, that sometimes our emotions make us make those mistakes?
There are. So, Brett actually, highlights what has been happening for many, many years in the market, which is people tend to do the exact opposite of what they should be doing, right? They should be investing when the market's low and selling when it's high. Instead, they jump back in when it's high and then they sell when it's low. So I think what average investors, mom and pop folks need to do, those who are saving for retirement, living in retirement, is to sort of disregard the market and focus more on what it is that I need from in terms of returns, and what kind of risk am I willing to take. What happens is, reality gets in the way of what people say they will do, and it's much different from what happens when the market crashes 20%. They say things like, "I can withstand a 20% drop in the market," but in reality they can't, because when it happens, they do what Brett said: they sell. And right now, what's happened is people are so far behind the 8 ball that they're trying to make up for lost ground. So they're taking on, in some cases, much more risk than they ought to be taking on, because they feel like that they've lost so much between 2008 and now, and they need to get back to even, or they need to get back above even. So they'll put more at risk than they should, and with the market at an all-time high, that means that they'll, further put their retirement plans at risk.
Well, you've talked in the past, Bob, about how for some retirees, especially those who are relying primarily on Social Security as their main source of income, what you do have in the nest egg, you have to look at your basic expenses and maybe find something that's got some sort of guaranteed rate of income payout just to build that base beneath you, correct?
Right. So the other approach, besides the 4-bucket approach, is the one that has been sometimes referred to as the product allocation approach. And that really means, okay, what I need to do is to create a floor of income using Social Security, a pension if you have it, and maybe some form of income annuity, either deferred or immediate, let's say, that will provide a steady stream of income, part of which is adjusted for inflation, and that will guarantee a standard of living that doesn't have to sort of be at the whim of market returns. And in the product allocation approach, you'd have, yes, the income annuity, a Social Security, but you'd have your mix of risky assets, your stock and bond portfolio, that would be there to provide what sometimes people call upside against living too long, upside against inflation, upside to fund discretionary wants, let's say.
Right. Once upon a time, this was easier, right? When you could find 4, 5, 6.5% fixed yields, but without those yields there, do you find, Robert, as you write and talk about retirement and teach classes about the economy and retirement, do you find that people are torn because the fixed rate yields are so darn low, people feel like they have to take on more risk?
Yeah, it's all easier said than done. In an academic and purely theoretical world, this is what you would tell people to do. And then when you say, well, go find something that pays more than 1% that's safe, I can find something that pays 1% and that's safe, but it won't necessarily fund my retirement expenses. And so that's where the rubber really meets the road, is how do you do it? And some people will suggest that you take a barbell approach at the moment, or you ladder your bonds, right? Where what you're doing is having some of your fixed income securities in a short-term instrument, some in an intermediate, some in a long-term, and that way as interest rises or falls, you're able to just keep rolling over your fixed income securities, so that at least what you're doing is getting a blended interest rate, and it may not be the best rate, but at least it doesn't expose you to all the things that could go wrong, at least in the fixed income world, where interest rates suddenly spike up, or I don't think this will happen,
right,
or suddenly fall.
Robert Powell from MarketWatch.com. There's much more to cover, but we're just out of time, Robert. Thank you for the time. Call the Presley Group. Let us show you how our fixed indexed annuity strategies can provide you great upside potential, protection of your principal and your annual gains, and create that guaranteed income if necessary. Again, our number is 791-5773. Our website is safemoneyplan.net.